Just about everyone in this room has one or more corporations. Up until the late 1980s, the only choice we had for a corporation was a company, and at the end of the name it will say Company, Corporation, Corp, or Inc., INC, which stands for Incorporated, not Indiana. So those companies had to be taxed in one of two ways. There were only two choices. There was S Corporation. Did Kevin mention S Corporation and C Corporation this morning while you were listening? Okay. So there's S Corporation, where the income and deductions flow through to your personal return and are taxed at your personal bracket and avoid employment taxes. And then there's C Corporation, where the company is a separate taxable entity. It's usually in lower brackets on the first $100,000 of income, and then above that, you would give yourself a bonus at the end of the year to get it a tax deduction, so you would what we call zero out the taxable income. And those were our only choices. And S corporations have some problems. We don't like to put real estate in S corporations. Here's some reasons. With an S corporation, you cannot have preferred and common stock. You can't have an S corporation shareholder that says, shareholder agreement that says, I get the first profits, you get the rest. Or you take the losses, you get this or that. You can't have those things. If you have those things, then it turns into a C corporation and really bad stuff happens. A lot of you have formed your own LLCs, and a lot of you have filed an S election for the LLC, which is fine. An LLC is a separate thing that can be taxed as an S corporation. But if your operating agreement, which you got from LegalZoom, accidentally has a provision that causes a second class of stock, then all these years when you've been pulling this income out of the S corp and the S corp hasn't paid any tax, you're in huge trouble. Because when the IRS audits it and sees that LegalZoom LLC operating agreement and sees that you would not have qualified under the S corp rules, they're going to go back as far as they can, at least 6 years, and double tax all your income. So if you have an S corporation, you need to make sure that somebody has closely reviewed its documents, because my hit rate, even when another law firm has done the work, my hit rate is 15% of the time I find a flaw in an operating agreement where the client thought they had an S corp, but maybe they didn't. So that's one of the ladders that you're climbing on in your business. Now, in the late 1980s, the LLC became accepted in the United States. It was in Europe and South America for decades. It used to be called a limitada. It's called a limitada in South America, but it's called an LLC for limited liability company. Now, with a limited liability company, it can be taxed in 4 different ways. 4 different ways. The first way is it can be disregarded if it only has 1 member. So if I own it and my daughter owns it, that's not 1 member, that's 2. But if I own it and a trust that I set up that's properly drafted owns it, even though that trust is for my daughter, then it's disregarded for income tax purposes. It does not have to file tax returns. It doesn't pay tax. All the tax gets paid at my level, so that simplifies it. So that's the LLC disregarded for income tax purposes. But you get a taxpayer identification number for it usually, and your CPA writes a little 1-page form to the IRS. This entity exists. All of its income and deductions are going on Jennifer's tax return. So that's disregarded. An LLC can be taxed as a partnership. If you're going to have a multiple member LLC and it's going to own real estate, then please have it taxed as a partnership, not as an S corporation. With a partnership, you get the flow through like an S corporation, but you don't have some problems that an S corporation has. If I transfer an appreciated asset out of an S corporation, I'm considered to have sold the asset. So if I have a $1 million building with a $400,000 basis and I want to transfer it out to do some planning because things change, if it's in a partnership, no tax. If it's in an S corporation, tax on $600,000. So that's why you want to have an LLC with a proper operating agreement. Now, another reason to have a proper operating agreement on the LLC taxed as a partnership is that if one partner dies and you want to get a new income tax basis on the real estate, which you definitely want to do because you can depreciate from the fair market value on date of death, you don't get that step up unless the partnership has certain language and your CPA makes what's called a 754 election. So it's just another reason that I point out that these operating agreements are problems. In addition, you won't get charging order protection under an LLC unless the operating agreement has or doesn't have certain language. So remember the charging order, those of you who were awake during my talk this morning, which was just like a minute ago, wasn't it? So just before I talked about North Virginia, I mentioned that if you get a judgment against somebody and they don't own the whole LLC, then in most states there's a charging order. A lot of lawyers set up an LLC wholly owned by the one person, and they set it up in Nevada or Wyoming or Delaware because they have statutes that say that the judgment creditor of a single member LLC can't reach into the LLC. That may work if you live in Nevada, Wyoming, or Delaware, but if you live in Florida, which requires multiple members, then under the conflict of law rules, which many people don't know about, Florida law may apply. So again, you want the multiple members. Now the LLC, like I said, can elect to be treated as an S-corp. So many times a client goes, I have an LLC. Well, is it an S-corp? No, it's an LLC. Well, is an LLC taxed as an S-corp? So I just saved you that conversation. There's also something called a general partnership. It has nothing to do with the military. Don't even think it has anything to do with the military. A general partnership goes back to the 1500s. If any two people or companies did something together for a profit, it's a general partnership. And a general partnership, every partner is responsible for the liabilities caused by any other partner. So I own a building with my brother. We file it as a general partnership. We don't need any documents. He's on his way to go get a survey to go to refinance it, and he hits a child on the bicycle. The bicycle's broken, and I have to pay for the bicycle because I'm his partner, and he was on partnership business. And if we don't have a special policy to cover that, I'm in trouble. So just never, ever, ever be in a general partnership. Never do that. You can be in a limited liability partnership, which limits the liability of each partner, but there's no charging order protection in a limited liability partnership. Or you can be in a limited liability limited partnership, which gives you that charging order protection. That's easy, right?